The crypto market is waking up. And this is not a coincidence. New macro data has sharply increased the probability of a Fed rate cut this week already. And this could be the beginning of a major cycle that pushes the market all the way through 2027. Today I'll show you why I'm so bullish, what to expect from the Fed next, and what all of this means for Bitcoin in 2025 to 2026. Subscribe, drop a like, and let's go. Before we begin, this is not financial advice. Everything I say is my opinion and my personal judgment. Use it as an additional perspective, not as a call to action. Let's start with the main thing. The market does not rise on its own. It reacts to the Fed. Right now, crypto has zero local drivers capable of adding hundreds of billions in market cap within days. Everything we're seeing is directly tied to macro. Fresh labor and inflation data instantly changed market expectations. The probability of a rate cut next week jumped to almost 90%. This is no longer a maybe or if we're lucky. It's the base case. And this is exactly what's pushing crypto upward. Not whales, not ETFs, not some new hype narrative, but the expectation that money is about to get cheaper. But is it really that simple? Let's find out. Why is the Fed even backed into this corner? Here, the labor market comes into play. Look at the fresh employment numbers. ADP doesn't just show slowing growth, it shows an actual negative print. The market expected plus 20,000 to 30,000 jobs. The real result? About minus 32,000. That's not cooling, that's breaking. And for the record, results this bad were last seen way back in 2023. What does this mean in real life? Less work, less income, less consumption. People cut spending, companies pause investments, credit becomes toxic, and this doesn't just hit lower income groups. Data shows payment issues rising even among those earning $150,000 plus per year. There's also a strange situation with weekly jobless claims. The headline numbers look very positive, but experts say the improvement is anomalous and may not reflect actual conditions. Add to this the elevated layoffs and the old problem that small businesses are being choked by lack of credit, which essentially stopped being accessible for them at all. Now remember, the Fed has two mandates: stable prices and high employment. Inflation is somewhat under control, employment is moving in the wrong direction. Keeping rates high in such conditions equals killing the economy with their own hands. And that's why the market is aggressively pricing in a cut. The Fed has boxed itself in. They either start easing or openly admit they're willing to sacrifice the labor market. Given all of this, it becomes clear that the Fed is almost guaranteed to cut tomorrow. But will this be a positive catalyst right now? Let's break it down.
3, 2, 1, fire!
First, we need to clarify. Markets have already priced in a rate cut, meaning yes, it's very likely already reflected in Bitcoin's price. This has happened many times before. 2 weeks ago, I told you about the massive positions being accumulated by big players plus the enormous open interest in call options. That's direct proof that the market isn't reacting to the news itself. It reacts to expectations. Whales know this better than anyone. This means we're not watching the rate cut. We're watching Powell's rhetoric. That is what ultimately drives volatility. If Powell comes out and says, in central bank language, inflation is under control, the economy is slowing, we are ready to support growth, that is a literal dovish signal. Translated into normal language, we're moving toward easier policy. Rates will be lower going forward, and we're not afraid to admit it. This is exactly what markets want to hear. So this time as well, Powell's tone will be everything. And remember, last time his cautious tone triggered a positive reaction. So let's fix the outlook. If we hear dovish commentary, the market likely continues upward. But don't forget, before the Fed meeting, volatility is always massive in both directions. But Powell has another problem. Inflation is not dead. It's down from the peaks, but not at the 2% target. Several Fed members openly fear repeating the mistake of the 1970s, easing too early, triggering a second wave of inflation and looking foolish in hindsight. As of December 2025, 5 of the 12 voting FOMC members publicly expressed skepticism or resistance to further easing. So, if Powell's message is more cautious or even negative, we could see a market reversal back into the sub-90K range. And now, the worst-case scenario. Powell says there will be no cut, or even worse, that the Fed may raise rates. In that case, the market almost certainly breaks below $88,000 and stays bearish until 2026. Why 2026? Because Powell is getting replaced in 2026. Trump's team is already applying pressure, and the market knows perfectly well that the next Fed chair will almost certainly be dovish. Trump confirmed the new chair will be announced early 2026, and the moment he said that, analysts exploded with predictions of a softer candidate. And that's a bomb for the markets. Soft Fed chair equals higher probability of cuts. But it's also important that those cuts actually improve conditions, not just act as cosmetic moves. By the way, I can't ignore a few more important points. On December 16th, we get the full U.S. labor market report, NFP, unemployment, and wage growth. On December 18th, we essentially get a mini FOMC. The CPI for November drops, and this will be the first normal inflation print in 2 months. If the number comes in hotter than expected, the market gets a cold shower. If it comes in lower, that's a direct boost for Bitcoin and equities because it increases the probability of a rate cut already in December. And then we have the key event, the Bank of Japan meeting on December 18th to 19th. Japan plays a central role in the global carry trade, so its decisions have a massive impact on global liquidity. That same day, the ECB also announces its decision, which can further support a risk-on environment. After that comes the Bank of England. The UK economy is still stuck in stagnation, so even a slight shift in tone from the regulator immediately affects capital flows and overall market sentiment. And again, the Bank of Japan is the main wildcard. If they keep the rate unchanged, global capital conditions remain supportive, but if they signal a possible rate hike, the yen could strengthen sharply, which would drain liquidity from global markets. Friends, thank you for watching. Drop a like, subscribe to the channel, leave a comment if you want to see a second part, and remember, this video is not financial advice, just my personal view of the market.